again, what's going on? It's Samuel Joseph here for Cultivate Forex, and today we're talking about trading psychology and risk management. Now, prior to now, we've discussed about how you can get involved in trading. We started off by identifying what the Forex market is. We defined what the Forex market is, and we spoke about how you can get involved in trading, registering with a broker, getting a charting software, and then we moved to technical analysis. We talked about how you can, identify certain areas on the chart based on structure, how to get involved in a trade. We talked about different concepts you can apply to, selecting an entry, how to get involved immediately after liquidity has been taken, and then have price move in the direction you expect it to go, trading with the trend, like we said. So right now we are talking about a more theoretical concept. It's more about your psychology, and here we'll be doing a lot of calculations when we now go into risk management, so you know exactly how much you're getting involved with in the Forex market at any point in time. So here's my promise to you. At the end of this video, here's my promise to you. You should be able to identify your own trading style to know if you're going to be swinging, if you're going to be an intraday trader, or you're going to be a scalper. And you should be able to calculate the value of a pip. So when we say price has moved 50 pips and you use certain amounts to enter that position, maybe certain lot sizes, you should be able to estimate the value of a pip based on the lot sizes you are using in trading, and you should be able to know how much you are risking or winning per trade at the end of this video. Okay, so let's jump right into it. Let's talk about psychology. All right, what is trading psychology? You've heard a lot of traders say trading is 10% analysis and 90% waiting, and you've heard several mantras like that. I'm here to tell you that it's the truth. Basically, as a trader, you are not paid to take action per se. Once you've taken an action in the market, the bulk majority of the funds or the profits you make is from sitting in your hands and waiting and watching your trades play out. And it takes a strong psychology to be able to achieve this effectively. So one of the key things you should get into your mindset is this: trading is not a get-rich-quick scheme. Trading is not a way for you to just make some quick money, or you can make some quick money, but if you want to stay in the game, or you want to make some quick money, in quotes, consistently, then you're going to have to develop the skill sets necessary. And it's not just about tapping buy or sell. A cat can do that. A dog can come on your computer and hit buy, and then the market moves up. Your dog makes profit. A cat can walk, or anything can happen, and you accidentally hit a buy or sell. You can do any mini money more and sell, and then the market moves in your favor, and then you make a shit ton of money. But that's not what we're talking about. All we're trying to consider is how you can duplicate your processes consistently and repeat whatever needs to be repeated, so you can trade consistently and remain profitable consistently. That's our watchword. So how do you do this? The first thing is you have to develop a strong psychology. Now, psychology. What do we mean by developing a strong psychology? It's the mindset. What kind of trader are you? Are you the kind of trader who's willing to risk, a lot of money to make a little amount of money? What habits are you going to allow in your trading? What habits do you have to disallow to achieve consistency with your trading? All of this put together forms the bedrock of the psychology you approach the Forex markets with. First of all, you should understand that it's quite a chaotic market, and the market will do whatever it wants to do. It will go wherever it wants to go, but it's up to you to isolate what particular time, for instance, you want to trade, what particular strategy you want to trade, how much of your account you are willing to risk per trade. Putting all of this together forms your psychology in the Forex markets and how you are going to trade. And one thing I like about a career as a Forex trader or a technical analyst is this: the process of becoming a profitable trader is an enjoyable one, because it doesn't just build your profits or your portfolio, it also builds you as a person. So you have to enjoy the process and develop those habits that are consistent with, a profitable trader. You have to think like a profitable trader and act like a profitable trader. All right, so let's jump right into it. The first thing I want you to understand is whenever you're approaching the market, you have to consider this one thing. You are not just throwing money to the air and hoping to make a profit from it. No. You should approach trading like a business. So take, for instance, you're about to enter into a position. What you should see is, I'm risking so and so amount of money in order to make so and so amount of money. So the amount you're willing to risk, take it to be the cost of entering that trade. Let it be that you have determined in your mind that it's going to cost me X amount of money to enter into this position. So if it goes wrong, my cost has been, I've paid the price to enter into this position. And if it goes right, yes, the price I paid actually brought me so and so amount of profit. Having that mentality will give you a very firm foundation to start with. Then the second thing I want you to understand is your own temperament. What kind of person are you? Are you a very patient person? Are you someone who is very anxious and not patient? Or how is your time like? Are you someone who has a couple of hours to spend and sit in front of the screen? Or you're a very busy you're a professional working in, say, maybe a hospital, you're a dentist, you're a lawyer, and you don't have the luxury of that time to spend on the screen? Or you're a student in school, for instance, and you have so many assignments and so many projects to work on, and you can't spend so much time on the charts. It's easy. Or where you're even trading from, what country you are trading from. Let's say, for instance, you're in Australia and you're trading in the Australian time zone, and you can't trade New York in the daytime. You have to wait till it's nighttime when others are sleeping for you to be able to even identify a trading opportunity. All these play an important role in determining the kind of trader that you are. But broadly, would classify you into three. It's either you're a swing trader, you're an intraday trader, you are a scalper. Four, I beg your pardon. The fourth is a position trader. I think we've mentioned this before. So it's either you're a position trader, you're a swing trader, you're an intraday trader, or you're a scalper. So depending on how much luxury of time you have to sit in front of your computer and stare at the screen all day, that would determine the kind of trader you would be. So if you don't have so much time on your hands, you could be a position trader. If you have the capital for it, you can hold your positions for about a year or so. You're a swing trader, you can hold your positions open for a couple of months, a couple of days up to a couple of months. You're an intraday trader, you're mostly opening and closing your trades every single day, taking the profits as it comes, right? And then you are a scalper, you're leaving your trades open for a couple of minutes, 5 minutes, 10 minutes, 30 minutes, as the case may be. It depends, right? So for me, I'm an intraday trader, but most times I get the opportunity to identify swing trades and I take them as well. So you might see me catching maybe 1,000 pips, like some trades I did on gold, or you might see me catching just 50 pips in a day and I'm done for that day. That's the kind of trader I am. I don't swing for extended period of times, or I don't hold positions for up to months, as the case may be. I may just hold a position throughout the day or a couple of weeks, a couple of months at most. I think the longest period I've ever held a trade open has been for maybe 2 months or so, thereabout, not more. So depending on who you are, your risk affinity, this would all come together to making the kind of trader that you are. And that's why some certain trading strategies are not for just everybody to trade. Okay, so let's double down to our screens and then let's fulfill our objectives for today. All right, so with that understanding of your trade psychology put in place and trying to identify your trading style, let's move forward to calculations. So first things first, we've talked about what lot sizes are, but we're going to discuss them a little bit more today. So what are lot sizes? What's a pip? What's the value of a pip? And we'll also look at the position size template for different account sizes, how much you should be risking per trade based on the account size that you have and the kind of risk affinity that you have. So at the end of this video, this is what we should be able to get. So let's start with lots. What are lots? Lots are simply the packets, or the lots are the quantity in which trades are placed. So take for instance, you want to place a trade on okay, this is GBP USD, and you have $1,000 in your account. Are you risking the entire $1,000 in your account to place that trade? Or what percentage of your account are you risking to be able to take that trade in the first place? So this will bring us to the kinds of lots that we have. So let's look at them. First, we have what we call let's start from the smallest. We have a micro lot. And a micro lot ranges from 0.01 all the way up to 0.09. So now when you're trading a micro lot, this is usually for people who have small accounts, right? You're trading a micro lot, you're trading from 0.01 to 0.09. And usually with a micro lot, you are trading about 1,000 units of a currency pair. That's 1,000 units of a currency pair. So if you are trading 0.01, you are trading 1,000 units. If you're trading 0.02, you are trading 2,000 units. If you're trading 0.09, you're trading 9,000 units of that currency pair. You get it? All right. So now the next thing we have is a mini lot. A mini lot. So if you're trading a mini lot, you are trading from 0.10 all the way to 0.99, right? So if you're trading a mini lot, altogether you're trading about 10,000 units. That's 10,000 units. Oops. You're trading about 10,000 units of a currency pair. What I mean by we'll discuss that later. Let's look at the third one. Then we have a standard lot. Standard lot. Okay. So when you're trading a standard lot, you are trading, yes, you guessed it right, 100,000 units. But before that, what's the range? A standard lot ranges from 1.00 lot sizes to either 100 or 200, as the case may be. Different brokers give different limits to the lot sizes that you can trade. Okay, so this gives you an idea of what you're trading as a trader, or what quantity you are trading in the market as a trader. So these are the various lot sizes we have. And when you are trading a standard lot, you are trading 100,000 units of that particular currency pair. Okay, so there you have it. A micro lot, you're trading from 0.01 to 0.09. That's what you're trading. And you are trading 1,000 units. If you're trading a mini lot, you're trading from 0.10 to 0.99, which is about 10,000 units of the currency, as the case may be. So if you're trading 0.1, you are trading 10,000 units. If you're trading 0.9, you are trading 90,000 units. So that's what you are purchasing. That's the quantity of that currency you are purchasing, right? So if you're trading a standard lot, you're trading 100,000 units. So if you're trading 10 lots, which means you're trading about 100,000 units, 100,000 units multiplied by what? You guessed right, 10. So you are trading 1,000,000 units of that currency. Now, how about if you're trading 100 lots? You're trading 100 lots multiplied by 100,000 units of that currency, which means you're trading 10 million units of that currency. What is a unit of a currency? If you're buying GBP USD, for instance, you're buying one value of GBP at the current exchange rate, or 1 unit of GBP at that exchange rate, right? And remember, we said you make profit in Forex markets by holding on to a currency when what happens? When the exchange rate changes. So let's go ahead and talk about the next concept we have here. With that in mind, let's look at the next thing. And the next thing we're looking at is a pip, and I'll explain to you what a pip is, and we'll later on look at the value of a pip based on the different lot sizes that we are trading. All right, let's get into it. Now, when we talk about a pip is a short form for points in profit or percentage in profit, whatever the case may be. But to take out the Forex jargon, this is what basically a pip means. A pip refers to a step that the market moves. So let's say, for instance, okay, let's write that out. Pip. A pip refers to points in profit or percentage in profits, whatever the case may be. That's the abbreviation. So let's say we're looking at GBP USD and the market moved from let's say 0.94 thousand, 94,000, and it moved all the way up to 0.09. Oh, this was 94,000. Okay, not 9,000. 94,000 to 0.094,001. Let's use that for the first example. This will be referred to as a pipette. A pip is the 4th decimal place after your exchange rate quote. So let's say a price moves like this. It has moved 1 pipette. Okay. If price moves from 0.094 thousand all the way to 0.094 1010, the market has moved 1 pip, the 4th decimal place. Remember, let's look at it together. This is 1 2 3 4. So this 4th place is the pip. Let's go ahead and do this. Let's say you have an exchange rate quote 0.094 thousand. Okay, 0.094 thousand. Let's make this big. Great. So now, first thing you see here. Okay, let's do it the other way around. This is a pipette. Let's write that. Now, not the literal pipette you use in a science lab, but it's just a unit of a pip. That's what I mean. Okay, that's a pipette. Now, the next thing we have is a pip, which is the 4th decimal place. So let's write that down. Once you see this, you know that the market has moved 1 pip, right? Now, in the same vein, when the market moves from we're looking at 0.094 thousand as an example. If it moves from 94,100, it has moved 10 pips. Recall from 100, tens, unit, and all of that. So for this, we'd say the market has moved 10 pips. That's in tens. If it moves from 94,000 to 95,000, then you guessed right. Again, how many pips? 100 pips, exactly. So in that case, the market would have moved 100 pips, right? That's on major currency pairs. And then if it moves from 0.094 thousand to 0.104 thousand, for instance, it has moved 1,000 pips. You got that right. Let's readjust this. So over here, we'll say price has moved 1,000 pips. It's not every day that price moves 1,000 pips, so it's a big deal if price moves 1,000 pips or you catch 1,000 pips. It's quite a big deal. Okay, so this is basically what we have on major currency pairs like GBP USD, Euro USD, AUD USD. But when we are considering other pairs like gold, XAU USD, there's a little bit of difference to it. Or when we are considering pairs like the Japanese yen, I don't want to leave this screen, but usually the Japanese yen is not quoted. There's not just 1 digit before the decimal number. There's 3 digits ahead of the decimal number. So when you are quoting a Japanese pair like a USD JPY or CHF JPY or Euro JPY, there's a little bit of difference to this calculation, and I'll show you that shortly. So let's continue from here. I just want you to understand what a pip is and how you can track it. So let's look at my cursor right here on this point of the screen now. Here, where we have my cursor hovering here. If you notice, we're at 0.9, let's take it to 4,000. This is 33,900, this is 4,000. Okay, let's leave it at this. We have price currently at 0.94097. When price moves from here, from 0.94, oh, we're working with 0.09, but anyway, let's leave it at this. When price moves from here, for instance, to, let's say, 94, we're looking at 94 and 22, 9,000, beg your pardon, 94,022, that's 0.94,022, and it moves to, let's say, 94,097. How many moves is that? We're going to take away 22 from, 22 from 97. Let's pull out our calculator and do that. So we have 97, take away 22. You understand by using the two last digits from the quote, that's the exchange rate, right? So we have 75, which means that market has moved 7.5 pips, not 75 pips. Why? Because the last digit is a pipette, remember? And we have one pipette, that's 5 pipettes in this case, and then from 2 to 9 is about 7 pips. That's why we have 75 pips, as the case may be, right? So take up more examples and then work on this. However, there's a tool that just helps you calculate this. If you like using TradingView, for instance, you can calculate the value of a pip just by hovering from one exchange rate to another. Let's say this is your entry, and then you go ahead and you drag price to where you want to place your stop loss. Looking at it already, this is 100 and this is 17.2, right? Which means you have a stop loss of about 17 pips on this. That's, beg your pardon, this is about 294.99. That's about 294 pips. Pardon me. If we look at the calculation from here, the difference you'll see we're on a daily time frame, so every small move is quite significant. Okay, let's take this off. Let's get back into it. So we've looked at, we have a little understanding of psychology and its role the role it plays in our trading. We have a little bit of understanding on the kind of trader you want to be. So based on your time, your availability, your risk affinity, you can decide the kind of trader you want to be. If you're extremely happy sitting in front of your chart, you want to scalp, that's totally on you. And the strategies we teach would work on every single time frame because the markets are fractal. So whatever happens on a smaller time frame happens on a larger time frame. So you can go ahead and apply these strategies to any time frame you want to, and you'll have them work for you. Okay. So now we've talked about lots. We said currencies are traded in lots. That's like in packets. Let's say if you're going to buy eggs, you buy them in crates, right? So in the same manner, if you're going to buy or trade currencies, you trade them in lots. And we have standard lots, mini lots, micro lots, as the case may be, with their different values, right? We've talked about pips. A pip is just a move from one point on the exchange rate to another point or to another exchange rate that has been quoted. That's from one point to another. Once the market moves, the exchange rate changes. We classify that move, or what we are using to define that move is the value of the pip, or is the pip movement. How many pips has the market moved? You hear some other trader friends asking questions such as, how many pips did you catch on so and so trade? So that's what they mean. How many pips did the market move? That's the steps that the market has taken since maybe when you placed the trade or exited the trade or whatever the case may be. Okay, so now let's delve a little bit deeper into calculating the value of a pip. I'm going to have to take all of this. Okay, let's bring this over here. Let's just take it out. Okay, let's take it all out. Just a minute. Okay, let's bring it all here. Great. So let's now look at something else. We're looking at the value of a pip. Now, when you are trading most major currency pairs and price moves 1 pip, how do we calculate the value? how do you know how much you have made or lost or are making, or how much you are losing on that particular trade? That's why this calculation is actually important, and it will help you to determine how much you're making or how much you're losing per time. Okay, so let's go ahead and do it together. So let's say, for instance, you are trading GBP USD again, and let's say you have a $1,000 account. So your account size, your account is $1,000, right? Great. So you have $1,000 account size and you want to enter a trade. How much or what quantity of, how many units of a currency pair would you be able to purchase? Would you be able to buy? How many lots would you be able to utilize for your trading? This also depends on an important concept of leverage, right? How much leverage has your broker given to you? Leverage simply refers to the borrowed money that your broker gives you to be able to hold certain positions in the market. So if you're using a leverage of 1:500, it simply means every dollar you have in the market can control up to $500 in that market. If you have a leverage of 1:1000, it means every $1 you have can control up to $1000, which means you can buy 1,000 units of currency without or with a down payment of just $1. Well, let me not use that terminology because that will conflict a little bit with margin. But basically what it means is you can control certain amounts of money in the market based on your deposit. Okay, so that's the concept of leverage. Leverage is simply borrowed money that you have in your trading. So let's say you have an account worth $1,000, right? And then you want to get involved in a trade. And on this trade, you decide to use a mini lot. And a mini lot is what? 0.1. So let's say for the lot size, you decided to use a mini lot of 0. Okay, let's make it interesting. Let's use 0.5. This is a mini lot, right? 0.5. It falls under the category of mini lots from 0.10 to 0.99. So this is under the category. So let's say we have that. Your account, $1,000. The lot size you are trading is 0.5. And then let's look at your entry. So with this, we'll be able to estimate how much you are making and how much you're losing. So let's say you are trading GBP USD on this pair. You have $1,000 and you want to open a trade with 0.5 lots. How much are you going to be making, or how much are you going to be losing if you are right or wrong? Let's go ahead and look at it together. So let's pull out our trade tool, and let's say you opened a position at 0.9015, right? Okay, or let's make it 0.9000. Let's make it 0.9000. Okay, it's easier for the calculations to come in. And let's say your stop loss is at 0.89251. Now that's quite far. Let's make it smaller. Let's say you're at 0.9000, and then you have this. Okay, let's say your stop loss is at 0.89566, and your take profit is at 0.94007. Okay, let's go ahead with that. So let's say this was your entry at 0.9000. What happens is when you give that instruction, once you hit buy on your trading app, what happens is your broker automatically opens a position for you. I'm recording during the weekend, so I can't show you a visual example of this on my mobile device, but I'll try to paint a picture as vividly as possible. So let's say you are opening a trade worth 0.5, right? And you got in at 0.9000, which means, follow me now, which means you have opened 0.5 lots and you are purchasing. Remember, we said the value of a mini lot is what? 10,000 units. So we have, let's pull out our calculator here, 10,000 units multiplied by, what figure do we have here? 5. So you are trading 50,000 units of a currency. So let's say you purchased 50,000 units was the amount you purchased. 50,000 units of the currency. The next thing we want to look at is what was the price? We said the price was what? 0.90,000. 0.90,000. So let's go ahead and find out what quantity we are now holding. So once you clicked buy with 0.5 lots and price was at 0.90,000, what you've successfully done is you've purchased 50,000 units at this exchange rate. So let's go ahead and do the calculation. You have 50,000 multiplied by 0.90000. So this is what you have. You are holding 45,000 units of that currency. That's, of course, you know, the pound, GBP, USD, the way it's quoted, one currency is less than the other. So what value do we have here? We are holding 45,000 units of that currency now. So let's go ahead and put that here. You have successfully purchased 45,000 units. Now I'll show you where the profit you make from Forex comes from. Now, while holding on to this quantity, you purchased 50,000 units based on your lot size, and we multiplied it by the exchange rate, we have 45,000. Now, the exchange rate moved from 0.09,000 to 0.94007. Let's go ahead and calculate that. That is 50,000 units. This time around, you're still holding on to 50,000 units that you purchased, or let's say you bought 50,000 units at this exchange rate. This is the quantity you would have, right? So your 50,000 units are still there. That's what you purchased. But now the exchange rate moved to what? 0.94007. So how much are we gonna have now? Let's do the calculation. So we have 50,000 multiplied by 0.94007. So we have 47,003.5. Let's go ahead and write that down. 47,003.5. Great. So right now, the value in which you purchased has appreciated. So how much are you going to make? How much is your profit? So let's go ahead and say you closed out your position at this price right here. And let's do a little bit of subtraction. So we have 47,003.5. We are going to subtract 45,000 from here. So we're going to take away 45,000. Then we have 2003.5. That means for this trade, right? Once this trade occurred, you purchased at this price, you held on to it, and the exchange rate changed. And when the exchange rate changed, the value of the 50,000 units you purchased also increased in your regular currency, in your base currency, to 47,003.5. When we calculate the difference, we discovered you made a profit. Let's take equal to a profit of, what was the figure again? 2,003.5. So you made a profit of $2,000 by purchasing 0.5 lots and holding that trade when price moved this amount of pips, right? That should be about 346.26 pips. Let's do a little bit of calculation. That's 346.23 pips multiplied by 0.5. So let's do the calculation together. So we are taking let's see, what we did was we held on to 50,000 units of this currency pair, and the market moved 400.7 pips. So let's do a manual calculation. Okay, so we have 400.7 pips multiplied by our lot size. What's our lot size? 0.5. What's our profit? 200.35. We multiply that by the value of a mini lot, that's 10. So we have 2003.5. That's exactly what we have here. So a shortcut method, instead of coming through this approach, a short method to go about that would be this. You take your lot size and you multiply it by your number of pips, and you multiply it by 10 also. Did you get that? So let's say, for instance, you have the market moving 400.7 pips. You will take 400.7 pips, multiply it by your lot size, and multiply it by 10. That will give you how much you are making or how much you are losing. Let's say, for instance, price dropped and you didn't make a profit from the trade. You took a loss instead. How much are you going to be losing in this instance? So price moved 43.4 pips. Let's do the quick method first, and then we're going to do the standard method. Okay, so let's multiply this. We have 43.4. Let's do that. 43.4 pips multiplied by, what was our lot size? 0.5, which is this, and then we multiply this by 10, which means we'll be losing $217 if we were wrong on this trade, right? Let's put that over here, 217. If we were wrong, okay? So if it was a loss, this would be how much we would be losing if price was hitting our stop loss. Okay, so let's calculate it in the other way. We bought 50,000 units at 0.9 thousand, and we were holding on to 45,000 units of the quote currency pair. Now the exchange rate moved from 9,000, 0.90 thousand to 0.89566. So what do? We multiply 50,000 multiplied by, what was our stop loss? 0.89566. 0.89566. What do we have? 44,783. So we go ahead and write that down. 44,783. This is in the case of a loss. By using the second method, remember, this is the calculation. So 44,783. So what do we do now? We subtract 45,000. We subtract 44,783 from 45,000 that we got in at. This is the value we are now holding. This was the value we purchased. So we have 45,000 minus 44,783. And what do you have? 217. Right? So that's simply the explanation. So in this case too, we still have same figure, which is $217. I believe with this calculation, you'll be able to understand how much you are risking and how much you stand to win per trade. We have two methodologies that we have applied. The first is to calculate the units we are purchasing based on our lot sizes. Let's say you are using a micro lot, a mini lot, or a standard lot, whatever it is. Remember the value of that lot. We said for a micro lot, it's 1,000 units. For a mini lot, it is 10,000 units. And for a standard lot, it's 100,000 units. You take that figure and you multiply it by the exchange rate, and then you hold on to, that's the new quantity you would be holding, right? And then once price moves, you take the new exchange rate, multiply it with the initial units that you purchased, and then you do a subtraction and see the value you have left. That determines if you are holding a loss or you are in profit. A simpler method to apply would just to be to take your lot size, multiply it by 10, and then also multiply it by the number of pips the market has moved. All right. So practice with a few more digits. I suggest you practice with a mini lot, a micro lot, a standard lot, using different lot sizes. This will help you to be able to understand how much exactly you're risking in the market at every point in time. So with this, you can now frame a more solid risk to reward ratio, or you can frame a more solid risk profile. How much are you risking per trade? If, for instance, we're still working with $1,000 and you are not comfortable risking about 20% of your account, this is about 21.7% of your account if you are losing this. If you have a high risk appetite, you can go ahead and then increase these lot sizes. So what are the variable parameters that you can vary depending on what you want to risk? There are two of them. You can either vary your lot sizes. Let's say to reduce how much you're risking, you can reduce your lot size. Or you can reduce your stop loss. Now, based on the kind of setup you have, that will determine the kind of setup the stop loss you are going to use. So if you have a fixed stop loss, one of the things you should vary would now be your lot size. So make sure it is in line with how much you are willing to risk. In this way, you have a good risk to reward set in place. Let's take a quick recap of everything we've talked about so far. We started off discussing risk, your psychology. We talked about the kind of trader that you are, be it a position trader, a swing trader, an intraday, or a scalper. And we said this all depends on the availability of time, the time that is made available to you, and also your risk appetite and other factors that may play an important role as well. Then we talked about lots. We said lots are the quantity in which Forex is traded. They are traded, the currencies are traded in lot sizes. Then we talked about pips, and we talked about the value of a pip, and we talked about how much a pip is worth. Now let's round up by giving a simple template that ensures that you're risking the right amount of money. So here's a simple rule of thumb to use. If you're trading from a $100 account to a $900 account, it is advisable that you use a micro lot, anywhere between 0.01 to 0.009 to 0.09, right? If you're trading from $1,000 to $10,000, it's advisable you use a mini lot from 0.01 to 0.99. Then if you're trading above $10,000, you can conveniently use a standard lot. Okay, so I'll drop a sheet. There's already a template like that. It's in our community, and so if you want to get the hard copy, you want to get the soft copy, you want to see it, you can just drop a message in the community. It's one of the pinned messages in our community, so you can go ahead and look at it. Okay, so this will bring us to the end of this video. If you've had anything, if you found any value from this video, you can go ahead and drop some comments in the community, like I said. Or if you have any questions, you can as well drop your comments in the community, drop your questions in the community, and we'll provide answers to them. I'll see you in the next video. Don't forget to visit our page on Instagram and visit our YouTube channel. Hit the subscribe button to get more value, and also share some of the free contents we have with your friends so they can also benefit from the value we're sharing on this page. Thank you, and I'll see you in the next video.